Hello, everybody. Welcome to problem 17-8. So we have Brooks Corporation as a medium-sized company specializing in quarrying stone for building construction. The company has long dominated the market, at one time achieving a 70% market penetration. During prosperous years, the company's profits, coupled with a conservative dividend policy, resulted in funds available for outside investment. Over the years, Brooks has had a policy of investing idle cash in equity securities. In particular, Brooks has made periodic investments in the company's principal vendor of mining equipment, Norton Industries. Although the firm currently owns 12% of the outstanding common stock, they do not exercise significant influence over their operations. Okay, so that's important because we're going to be using fair value instead of the equity method of accounting. So Cheryl Thomas has recently joined Brooks as an assistant controller, and our first assignment is to prepare the 2020 year-end adjusting entries for the accounts that are valued by the fair value rule for financial reporting purposes. Thomas has gathered the following information about Brooks' pertinent accounts. Okay, so the first one is Delaney Motors. They also have Patrick Electric, and they also have Norton Industries. Okay. So over here, so during 2020, Brooks purchased 100,000 shares. So the total cost of these shares were 1.4 million. So that means that my cost per share of the Delaney Motors was at $14 per share. Okay. Now, this is my cost, right? So it's telling me that the fair value of these shares is 1.6 million. These shares currently have a fair value of 1.6 million. Okay. Let's take a look at our next investment. So this is as of 12/31/20. So for Patrick Electric, has not been profitable. The company acquired 50,000 shares at a cost of $20 per share. So what's interesting is that they don't like to give you, they'll give you one piece, but not another. So it's best to just kind of go through each one of these. So if they tell you bought it for 50,000 shares at $20 per share, that means I spent $1 million on it. So my fair value over here is 720,000 for Patrick Electric. Okay. The last one over here. So prior to 2020, we look at over here, and Brooks invested 22,500,000. Base of 22,500,000, and has not changed its holdings. This investment in Norton Industries was valued at 21,500,000 on December 31st, 2019. And it has a current, Brooks's current amount, or 12% ownership, has a current fair value of 22,225,000. Okay. So as I go through and I look at this, right? So right over here, I've got a total cost here of 24.9 million. I have a fair value of 21,545,000. 24,545,000. But the one thing that this is kind of telling us here too is that in 2019, right, it tells us that my cost of my investment right over here, of my equity investment, in Norton was 22,500,000, right? That's, I know what that is going to be my cost. However, what it also tells us too here is that the value of the investment in 2019 was 21,500,000. So what does that mean for us? Well, in 2019, in order to show my fair value of my securities properly, what I would need to go through and do, we'll call this equity adjustments, fair value. So if the total value of this Norton stock was 21.5, that means I had an equity adjustment here of $1 million. And the reason is because when I add up this equity investment in Norton, 22.5 million, subtracting out my equity adjustment fair value, I'm basically going to come up with 21.5 million. So my existing fair value adjustment is going to be at $1 million, right? Which is important to me because I need to figure out to see what does my adjustment need to be. So over here, if my total cost is 24.9 million and my fair value is 24.545 million, the amount I need, my fair value adjustment, is going to be, I should have a credit of $355,000. So right over here, in terms of my equity adjustments for fair value, so my beginning balance over here on 1/1/20 is $1 million, right? That came from 12/31/19. Okay, so my equity adjustment here is $1 million. But what I'm saying is now, well, the amount of the fair value adjustment I need is not $1 million, but it's 355,000. So then my adjustment over here is going to be a debit of $645,000. So at 12/31/21, my adjusting journal entry is going to be a debit to equity adjustments at fair value for $645,000, and I will be crediting unrealized gain, loss, income. Okay, so over here, so this is what I'm going to be going through and recording. I'm going to be debiting my fair value adjustment, and I'm going to be crediting the unrealized gain or loss on the income. More importantly, when I add in here my total cost, right? So my total cost is 24.9 million. This is just to check my work. And I have equity adjustments fair value because it's a credit ending balance. When I add these two, I'm getting to this balance that's right over here. So that's what I'm trying to go through and accomplish with this fair value adjustment. Okay. So for the securities presented above, describe how the results of the valuation adjustments made in A would be reflected in the body of their financial statements. So the unrealized holding gain or loss on the valuation on the equity securities is reported on the income statement. The gain would appear in other revenues and gains on the income statement. The fair value adjustment is a valuation account, and it would be used to show the reduction in the fair value of the equity securities. So this would be my equity investments. That's what I'm going to be showing on my balance sheet. The equity securities portfolio is disclosed on the balance sheet as an asset and reported its fair value. It's probably non-current in nature, meaning that if you're planning on selling it within the next year, it's going to be current. Non-current is going to be holding it beyond a year. So that's letter B. Okay. So the next one here is prepare the entries for the Norton investment, assuming that Brooks owns 25% of Norton shares. Norton reported income of $500,000 in 2020 and paid cash dividends of $100,000. So this is a totally separate assumption for this particular question. So over here, if Norton is in fact, if it's more than 20%, we don't do the fair value. Rather, what we're going to do is we're going to report the proportionate amount of income. So we're going to have equity investments. Okay, so then we're going to have, so over here, when I have, so if they had 500,000 of income, we're going to pick up 25% of that amount. Okay, so this is going to be the same over here. So 12, 31, 20. And at the same time, over here at 12, 31, 20, I'm receiving cash, and this is going to be in the form of a dividend. So this is going to be 500 soon. This is going to be 100,000, which is the total amount of the dividend times 25%. Okay. So right over here, and then I would be crediting my equity investment. So the net income increases it, the dividends decrease it. I don't do anything with regards to the market value of the stock. Okay. So right over here, there would be no adjustments for fair value. So that's it for this one. Thank you for joining me here today, and I look forward to seeing you on the next video. Have a great one.